everybody. Luke Gromen, Forest for the Trees, founder and president, FFTT. Hope that you are well and that you had a great weekend. We're doing the normal Sunday night Periscope here on Tuesday night as the U.S. holiday. Hope everyone had a good long weekend here stateside. Everyone that's watching us on the replay, broadcasting live in between 10 and 11-year-old soccer practice, and we're going to maybe throw some batting practice to my middle son later in a bit. So, as promised, the new format, we're going to do a quick sort of 90-second run-through of two things that really caught my attention recently. The first of these is the Yuan contract. There was an article on Reuters today. We actually tweeted it out with some thoughts that Reuters reporting that in July, the Yuan oil contract, in terms as measured by front month a contract, garnered 14% share of the global oil market, which by way of comparison, they said that the Brent contract took 20 years to get 14% share on the same metric. The Chinese did it in 4 months. And so we continue to think that a lot of investors are underestimating the importance of this contract, really from a couple things. Number one, if it's successful, it means China will be able to get more control of physical oil flows globally. That also means they will be able to control more of their oil import bill and deficits, and that ties into the balance of payment side for them, which is an important issue always and certainly these days. And then lastly, by extension of both of those, it gives them increasing control on the margin of the international trade value of the US dollar through the oil link, which is of course of potentially critical importance. So second thing, that's the first thing, is this Yuan oil contract. The progress there really caught us by surprise, and you know, we've been talking about it a while. The second thing is US ISM print today was the best number in 14 years since 2004, printed up in the 60s. I believe the number was 63. A couple things about that. It's a great number, no question. That is absolutely true. The other thing that is absolutely true is emerging markets are being squeezed by rising dollar, rising rates. The last thing that, given point one and point two about the ISM number and the EMs, is that U.S. ISM is being heavily driven, or the energy sector is punching well above its weight in the ISM. And when you look at the U.S. energy segment, the shale sector looks a lot like an emerging market. They are dependent on a weaker dollar, and they are dependent on cheap capital. And so to the extent capital is getting more expensive and the dollar is getting stronger, to us, we look at that ISM number, and it seems like the narratives of the strong ISM and the weakening emerging markets are at some point in the not too distant future likely to be mutually exclusive, or not likely to continue to be mutually exclusive. So particularly given that the oil market is really counting on what we've called the U.S. State Department oil market, which is you need India and China to abide by the Iranian sanctions. On that front, we did get news over the weekend that India is looking at providing or continuing to buy Iranian oil. There was some news about that. That will be important to watch going forward. So those are the two things that really grabbed our attention. You know, the Chinese oil contract progress update, and then the ISM number that we talked about before. While we're waiting here for the first couple questions, wanted to highlight, if you're interested in seeing what we're up to, please check out our website, FFTT-LLC.com. Just saw the first question here about Fed Bullard's comment about not raising rates. If that has, I did not see that today. If that has happened in the after hours, I have not seen the story yet. As I said, I was at soccer practice with my youngest son. But if he said that, if I'm reading that question properly, to us that would be a very big deal. You probably saw, we tweet the headlines of our reports for our full-length research reports, and the title last week is we had shifted back from our tactical dollar long or more bullish position on the dollar back to being bearish on the dollar, simply based on we think that the pressure of the rising dollar and rising rates on U.S. finances and the fiscal side is likely to become problematic much sooner than most people think. So if Bullard said that, if I'm reading that question right, to me it would be a huge moment. In fact, once I get off this Periscope, I'm going to have to run that down because that would be a very big thing. Thoughts on gold now? We'll continue to think that gold is the CDS or credit default swap of this cycle in terms of it's unlikely to do much until there's a real phase change in the market. And by phase change, I mean, I haven't seen the numbers tonight, but we've seen over the last 2 to 2.5 months, GLD has lost 75 tons. That physical has flowed somewhere. You can see Swiss data suggesting it's flowing from the UK and the US to China, Hong Kong, India. And so there's really a London Gold Pool 2 effect going on. And that's why I say there's this CDS, that's the gold's likely to be the CDS-like returns in this cycle. When you think back to the first London Gold Pool, you're talking about a time when U.S. creditors were effectively asking for their gold back under the Bretton Woods system. When your the price of gold at the time was fixed, and so the physical was moving, the price wasn't moving, and that continued for years until the U.S. closed the gold window. And at that point, you saw gold move up. At that point, it's $42. Over the next 9 years, it rose 20-fold. So that's why I say I continue to think there's sort of that kind of dynamic in play. Again, of course, gold is not backing the system in the same manner that it was in Bretton Woods. But that said, there's a clear effort afoot by China, Russia. Even Indian central bank just bought gold for the first time in a decade this week. There's a clear effort afoot to move gold back into the system in some capacity. We think as a neutral reserve asset. We think it's probably being eyed for settlement of commodity and energy trade in particular. Next question. Let's see. Myopic focus on the yuan historically means very little. Not sure on that one. Let's see. What's really going on in Syria? I think it has a lot to do with pipeline and energy politics in Syria. There have been some good articles you can find online. I would just start Googling and read up. Of course, you take it with a grain of salt, but there's energy politics afoot. You can see it also with Nord Stream 2, with the U.S. Trying to dictate energy policy to the EU vis-a-vis this Nord Stream 2 pipeline that's running directly between Russia and Germany. Thoughts on TLT? We continue to think that the rising, the clear breakout. One of the most important charts to look at in terms of really the big gears of what we think is going on in the world is the clear breakout on a 25-year chart. If you look at S&P 500 or SPX divided by TLT, so SPX over TLT, clear breakout on a 25-year chart. SPX over TLT continues to rise. Ultimately, when you look at the combination of the U.S.'s debt levels, U.S. obligations, U.S. reserve status, and the fact that U.S. foreign official central banks or the central bank sector of U.S. foreign creditors are no longer buying U.S. Treasury bonds, have not done so in 5 years, you're really in a situation that has not been seen since the period of 1942 to 1951, when the U.S. had debt to GDP over 100%, and foreign central banks, for obvious reasons, were not financing our debt. The Fed pinned yields at 2.5%, 10-year bonds. Obviously, you clipped your 2.5% coupon for 10 years, but you lost about 85% of your money versus the S&P in that time, and you lost about 75% of your money in that time against U.S. CPI. And so, to me, that is the same type of dynamic. Again, history, they say history doesn't repeat, it rhymes. But there is an element of that going on where continue to think one of the big trades of this cycle, SPX over TLT, which is to say, I don't know that I want to be short TLT on its own, but I do think it's a matter of national security that the TLT loses value on a relative basis to other asset classes. What's your tell that the phase transition has happened and it's time to be long gold? Gold is going to be, I think, there's that sign. I'm dating myself here a little bit, but there's a song from 1992 by Delamitri called "Always the Last to Know." The gold market is going to be the last to know because, again, pricing isn't set by physical movements; it's set by paper. And so you're talking about, the last two times a phase transition happened in gold. The first in the United States. First time in the last 100 years was when President FDR said, we're off the gold standard and gold's now worth 65% more. Have a good day. The second time it happened was when President Nixon preempted bonanza on a Sunday night and said, we're closing the gold window. Have a good day. And I suspect whether it's the U.S. that does it or whether it's an IMF or a BIS or a China or a Russia, I think that's why I say I think the gold market's going to be the last to know because it's going to be a political decision made in behind closed doors. The one way you'll be able to tell is you'll be seeing a reticence by central banks in certain nations to buy treasuries anymore. That's happening. You'll be looking at physical gold flows. They'll be going from west to east. That's been happening, and both of these two things have been happening for 5 years. So one of my best relationships on the street, veteran macro trader, something he says to me in a nod to President Nixon, Nixon's move back in '71, Luke, any given Sunday. I mean, if you came in on Sunday night or we came in next Monday and, hey, we had a phase change in the gold market, I would say, hey, that makes perfect sense. If it is 5 years from now, I could see that too. 10 years from now, that could probably happen too, but I think you would need some political changes to drag this thing on for another 10 years. And the reason I say that is when you look at the U.S.'s fiscal math, and I focus on the U.S. because the U.S. is the reserve currency of the world, it just doesn't look like the center of the current system is going to be able to sort of keep all the plates in the air for another 10 years. Thoughts on Russian debt dropping below $500 billion, adding gold. I didn't see the latest gold edition. I did see that they have basically cleaned out of treasuries per the USTIC report, and that they have nearing 2,000 tons of gold. Look, Russia is the biggest oil producer in the world. And the biggest oil producer in the world is buying gold and not buying treasuries. It's a huge message. And, I guess the other part of that huge message is Russia has been sort of, public enemy number one, or geopolitical public enemy number one, or 1A for much of the last 10 years or last 5 years. And so, we continue to think that those three things are not unrelated, to use a double negative in poor English. What's my best investment as a 30-year-old to retire at 50? Look, to me, if you're 30 and you want to retire at 50, probably your best investments are looking at investing in your own small business, something that's defendable. Look, I don't want to start a retailing business where I have to compete against Amazon, but some sort of intellectual property, some sort of, I do like competing against or taking market share from sort of other, I always tell my kids, the Dollar Shave Club guys, like brilliant, like that was a really interesting story. Then I believe they got Gillette to buy them out ultimately. But in terms of the ability to leverage technology, you don't need giant manufacturing facilities anymore to, with 3D printing, with some of the IP, with some of the technology, you can, I would look as a best investment as a 30-year-old looking to retire at 50 is invest in yourself and invest in some sort of small business that you can own and grow and build equity in that way if that's your goal to retire at 50. So that's a tough question. I don't know if that's a good answer or not, but you had said gold down, China losing, dollar up likewise. What do you think now that has happened? Let's see. I think there is the picture, and I think there's what's happening. There is gold down, China losing. Gold is down, and China's buying up the gold. And the golden rule says at the end of the day, for 5,000 years or so, whoever has the gold makes the rules. And so right now, the picture being painted in the paper gold markets is that, gold down, China's losing. That said, I'm not so convinced that that's the case for a whole number of reasons. So let's see here. Let's see. Is the U.S. in worse shape than Europe? Um, it's one of these things where I think we've said a number of times in meetings, you really have sort of a three-horse race, between the U.S., Europe, and China to see sort of who goes off the cliff first. And we would not, I think that's the right way to think about it. Most people analyzing this tend to think that Europe and China have a huge lead on the United States, and that the United States will be able to hit the brakes and sort of stand at the cliff and sort of observe them falling and going splat down in the Grand Canyon. Our view of it is that it's more like a three-legged man race, or where you've got three guys and they're each of them have their leg tied together, and maybe there's a little slack in the tie, but it's not very long. And so you're really looking at sort of three guys stumbling together towards the cliff, and maybe China goes first, maybe the EU goes first, maybe the US goes first. But here's the thing. Once one goes, like, the other two are going over pretty quickly shortly thereafter. And the reason we're so hyper-focused on the US is, of those three, only one is the current global primary reserve currency. And, our view is that, and the view of a lot of people that we've talked to, this sort of the current global economic system is unlikely, or currency system is unlikely to survive the next major crisis. And so that is sort of our view of that. Is the U.S. really number one in gold holdings? Not to be flip, but that's what they say. I believe that. Look, they're in U.S. military facilities. Big guys with guns with haircuts like mine say it's there. So we're gonna stick with that. Please talk about the tectonic shifts underneath. No, enough seriousness about that. For as much as the U.S. Has a publicly antipathy towards gold, the U.S. has a lot of very smart people, a lot of very smart finance and policy and strategic people. I think we have the gold. I think they just don't like to advertise it. Please talk about the tectonic shifts underneath the trade wars. Look, I think the tectonic shifts is a great question. Tectonic shifts underneath the trade wars is ultimately about this change in the global currency system. When you go back to early '09, the head of the central bank of China came out and said that they wanted to move towards a new currency system with a neutral reserve asset away from the dollar. And so this isn't secret. You can find this out there. This isn't some big conspiracy theory, which is something we've been accused of from time to time. China wants a new system. China has a problem in that if the price, they need to consume more commodities and oil to grow. And if those are all only priced in dollars, sooner or later they're going to get upside down. They're going to start running a current account deficit. And if they do, they're going to have to burn down the reserves. And they're going to be in the same position as Southeast Asia was, in the late 90s. And that is simply something they don't want to do. It's a matter of national security for them to avoid that. It will undo 20 to 30 to 40 years worth of very hard work for them to get to the position they're in. So the way you get out of this is you either find a lot more oil, you find a lot more commodities. Obviously, they've been buying up pretty much anything that's not bolted down, even some things that are, over the last 5 to 10 years, exchanging dollars for commodities, energy, future supplies. However, at some point, you can only buy so much. You're still getting all these dollar surpluses. The holy grail is to be able to print your own currency for oil, and so they're trying to do that. The flip side of that, and that's a matter of national security for them. The flip side of this is that for the United States, at least when it started, the reason you had to have dollars was you had to have oil. And there's been a network effect that has built off tremendously off that in terms of the euro-dollar financial system. But it all originally came back and rested on you had to have dollars to have oil and commodities. At this point in the game, you look at China, they have 26% of GDP in FX reserves. The U.S. has 0.6% of GDP in FX reserves. And the reason the U.S.'s are so low is because we can print dollars for any needed commodities. The FX reserve pile out there globally is about $11 trillion. That hasn't moved. That's about 2/3 dollars. If other nations can print currency for imports and other goods, the amount of those 11 trillion and, like I said, 2/3 dollars, so call it about $7 trillion, they don't need any of those $7 trillion anymore, and they will stop buying treasury bonds from the U.S. government because they have already got a pile of $7 trillion they don't need. They don't want to grow that pile. Once they stop growing that stockpile, the United States is on the clock for a fiscal crisis. We're going to have to pay for our own deficits for the first time in 70 years, and we can't afford it. So it's a matter of national security for the U.S. not to allow this either. So that's really the tectonic shifts is neither side can give in. They just can't, and it's a little bit of a scary situation. You read some of the work on Thucydides' Trap by Graham Allison. I would definitely direct you towards that in terms of understanding, when you've had this rising power and existing power tensions throughout the history. It hasn't happened very often, but 3/4 of the time it's ended up in war between the two. Let's see. CME inventory reports physical gold marked as available for delivery, approaching record lows. Yeah, that's kind of ties back to the point I made before, which is, physical gold is moving en masse from west to east. Price isn't moving. That can continue for a long time because, unlike most commodities, gold is not a commodity. It's a money-like asset, which you can tell by looking at its stock to flow. Gold stock to flow is like 60 to 65. Oil stock to flow is 1.2. And so while you can separate physical fundamentals from price for a long time in gold markets because of that, you can't separate them from forever. And so that would speak to the point I made earlier where, gold down, China's losing. That's a picture being painted. We'll see. It's in theory, physical inventory in the West can only go so low before somebody cries uncle, and that's why I also say the gold market will be the last to know when there's a phase change. Is Trump smart to try and bring manufacturer to flip the deficit? Politically, yes, I think it's smart. I think ultimately it would be very good for the United States. I think when you look out, 5 years, the way I look at the situation is as much of the coastal policymakers did not see a problem with China sort of taking over all the manufacturing of lower end goods. Now that China is talking about moving into high tech, and China is talking, and in China I am hearing specifically is winning deals globally on the basis of better financing, their banks beating our banks. I suspect that has at least a little bit to do with the fact that suddenly we've got a problem with what China's doing. And so, look, if you look back over the last 100 years, what we did to Britain, what China has done to us, finance follows production. Chinese banks are winning because Chinese manufacturers have the goods. Our banks won because we had the goods. And so to the extent that I think strategically it's I think it's the only way we win is to bring back manufacturing. I think you flip the trade deficit as a result of that, but none of that's going to happen with the dollar trading anywhere near where it is today and basically still being as the primary reserve status. Thank you very much for that compliment. Why are federal tax receipts not growing with 4%? Huge question, Gary. It's something I'm sure we'll be writing about very soon. Gary asked, why are federal tax receipts not growing with 4% plus GDP? And this is a question that nobody is asking. It's a question everybody should be asking. Trailing 3-month U.S. tax receipts in July were down 6% year over year. That's a recession. Now, it's not an apples to apples comp. We did have tax reform, but remember, tax reform, when you saw it with Reagan, when you saw it with Bush, we cut taxes, tax receipts fell for a few months, and then the growth in GDP, it was the old supply side, right? Growth in GDP, you leverage throughout the economy, and despite the decline in tax rates, you have an increase in tax receipts due to GDP growth. It's not happening this time. Now, we're still only 6 months in, and I say that, I was saying we're only 2 months in, we're only 3 months in, we're only 4 months in, we're only 6 months in, and tax receipts aren't growing. That's a problem, and that is a very big thing we're going to be watching. At some point, that's a really big problem because it's not like we're going to grow 4% on top of 4% or 5% on top of 5% with a strengthening dollar and rising rates. It's the structure of our economy is just not going to happen. So, will China float its currency? China understands the game in which it is engaged is very apparent to me, which is to say, the thing that nobody in the West wants to say is that we have absolutely used the dollar as the most potent weapon we have in our arsenal. China understands this. They understand that if they just willy-nilly open up their markets, we will bury them. And so they need to control the degree to which they open it. I think it's very elegant. You can get money in and out of China via physical gold. The West doesn't want to do that, though, because if you need to move as much gold as you need to move at current prices, you're not going to be able to do it. You're going to break Western gold markets, and that's going to be a problem for the dollar. And if you bid up the price of gold to move capital in and out of China, that's not good for the dollar either. And so, and away from what I think, look, you've seen comments from a Chinese general. I saw a comment from someone else over the weekend. It was the second time I've seen this. I forget which Chinese. Oh, it was the vice chairman, I think, talking about not wanting to be a vassal and that the United States has used its currency as a weapon. I think that's who it was. But the bottom line is you've had two different people in China in very senior roles talking about how the U.S. has used the dollar as a weapon against emerging markets in the past. So there's an understanding there. Will China float its currency? This isn't a purely economic question. This is a question of currency war. They understand it. Can't the West survive trading amongst themselves? Yes. Yeah, we just have to have, we need to make some more of our own stuff. Europe is short oil. We're long. We could be long oil at the right price of oil. The right price of oil is going to require a much lower dollar. But, that is, I suppose that's possible. I'm going to try to focus as much as I can. So, hey, that's it for tonight. I'm going to try to get out, throw a few pitches to my middle son, maybe play a game of horse with my oldest boy before tomorrow. So, thank you once again for joining us.